Yes, we'll start a chapter on capital structure. And yesterday we've seen capital structure in different format, only equity share, preference share, with debenture, debt, and all these things put together. All right. But issue is what? To address the capital structure, there are four theories. One, net income approach. Second, net operating income approach. Third, approach. And fourth is traditional prepositions, or as the case may be. Now, before we look into details of all these theories, we'll focus only on two. One is NI, second is NOI. Because why it is so? Because your approach, if presume one set of assumption will be equal to NOI, and if you assume second set of assumptions, it will be as good as NI. Clear? But we'll try and cover up each and everything. Now, you should not be worried about the lengthy numericals given in the exam, because this book has been written for all those who are doing something in finance, be it here or be it elsewhere, as well as those who are attempting to write their CS examination, CA examination, have been done for them as well. All right. Now, right. Before we try and attempt these theories, there is a certain set of assumptions are there. So you must appreciate those assumptions, and I believe that assumptions, whether you read economics or stats or quantitative, everywhere a set of assumption is there. Clear? It's said to be preconditioning. All right. So what are those assumptions? Number one, the company has only two sources of funds, or you can say long-term resources. One, debt, and second is equity. All right. The second set of assumptions which we believe are A, no tax. We operate in zero tax environment. Then neither tax on the firm nor tax on individual. So no corporate tax and no personal tax. All right. Then what we can say, this assume that firm can instantly change its capital structure. That is, it can move from debt to equity and equity to debt. All right, but without any transaction cost. Without any transaction cost. So presume no income tax, no personal tax, no corporate tax, right? And of course, we have only two sources of debt and equity. Now, yes, 100% dividend is there. Next set of them says 100% dividend is there. All right. And then of course, there is same, investors are indifferent. In fact, what we can say, investors are indifferent in the sense that they have got same subjective probability. They've got same subjective probability regarding future operating income. I mean, you can say investors are indifferent whether you have 100% equity or you have got 100% debt. He has assumed or he's prescribed same set of subjective probability. And this probability is regarding future flow or future expected income. Alright? And the last that we have is, yes, we believe the business risk risk arising out of your operation is constant and independent of your capital structure combination. So we presume business risk is constant, it is irrespective of combination of your capital structure. All right. So this is the few set of assumptions while dealing with theories on capital structure. Clear? Now, what is the basic point in theory of capital structure that we have to address? So the point that we have to talk about is what happens to the value of the firm. That's called V. What happens to the value of the firm if we change? If we change the quantum of debts in our capital structure. So what we have to find out? Currently, my D ratio is 30-70. All right, 30% is debts and 70% is equity. If I do the flip flop, 70 debt, 30 equity, right? What will happen to value of the firm? This is what we have to answer it. Clear? So what is the issue in theory of capital structure? That is we assume debt or debenture is decisive factor in determining the value of the firm. All right. And this value of the firm, as you have seen yesterday, is combination or total of market value of equity share as well as market value of debentures. So if you remember, we have defined this V as S plus D. You have different notations. You can say it can be equity plus debts, or some says S is the market value of shares and B is the market value of bond. All right. This is called value of the firm. Now, is this clear? All right. It is clear to all genius available physically? Sure? I'm not. Yes, Animesh.
Sir, is the value and return same?
No. I use the word net worth or net worth or net worth. Net worth or net worth. Worth. No, net worth is a different. So you talk about net worth. In fact, net worth turns out to be your book value. Value of the firm is what market perceive. Clear? And book value of the firm or net worth of the firm is what is endorsed by your books of accounts. So what is value of the firm? In simple language, the value of the firm means if at all I have to take over this company, how much cash money I have to shell out. Right? And whereas if I say the net worth means what I have earned over the years, and that too theoretical one. So this net worth is what your reserve and surplus plus paid up capital is said to be your net worth. All right. Now this reserve and surplus is what has been left over after having paid dividend, after having issued bonus shares. Clear? And after going for revaluation of your reserves also. All right. So net worth means theoretical. One extension of net worth is book value per share. All right. And how do we get this book value? Where is Austin? Not giving well?
He is not in town.
He's gone.
I have some.
All right. And Nipun?
Nipun has interview.
Oh. Job interview or
Internship.
internship? Good, 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 good. Please continue. All right. So,
The value is the amount that you have to sell if you have to acquire, right?
no. Sell it, you have to shell out.
Sell out, sorry.
आप पहुंचे में महात्मा है, आप कहाँ दुनिया में आ गए प्रभु? अवतार लिया कहाँ है संसार? नींबू मिर्च लेके आ, नजर उतार इसकी. Alright, come on. So you use the word. बेटा हिंसा नहीं, हिंसा नहीं, हिंसा नहीं. हम शांति प्रिय लोग हैं. हम हिंसा नहीं, हमारे यहाँ हिंसा का कोई भाव नहीं होना चाहिए. बिल्कुल नहीं. हम यूं नहीं मारते, हम तो उठा के खत्म, फिनिश. ना रहेगा बांस, ना बजेगी बांसुरी. राइट? ये क्या चूटिया भर दिया? कम ऑन. सो अंडरस्टैंड. माता नहीं. Yes. So net worth is book value, is accumulated earnings done by the company over a period of time, and this net worth is said to be what is leftover balance on account of profit, on account of reserve and surplus. Am I right? And when I say leftover, would simply mean out of having issued bonus shares, having paid dividends, having rewarded investors, is said to be like this only. The prime concern in net worth is not the amount of capital that we have increased. The prime component of this net worth is hefty, ever-growing reserve and surplus. All right? Otherwise, what will you say? You kept on issuing capital and the capital goes up. Whatever little reserve you have, your net worth will increase. No. The concept of net worth is the worth of a business over a period of time as done by the profit and surplus and reserve. Don't bite nails. It doesn't contain any protein, no carbohydrates. Am I right? Shedang Raju? वैसे तुम इतने strong body हो, क्या जरूरत है तुम्हें? All right, come on. So, what is the logic? Logic says, and why you have to decide value of the firm? You may ask. If I put other way around, how market perceives your organization is indicated only by one factor called value of the firm. Clear? For example, you heard the name of market capitalization. What is market capitalization? In simple words, that is number of shares issued or outstanding multiplied by market price of share. Alright? Clear? And when I say value of the firm is one component is market value of equity shares. What I say? When I say market value of equity shares means total market value of total equity shares available in the market or outstanding. Is this clear? Now, you know it very well. If you have to take over this premises, whose book value is, say, for example, 1,000 crore, but location, occupancy, development around will make you have to shell out not 1,000 but 2,000, 3,000 crore as the case. When this is said to be market value. Look at this. The fine example of this valuation is what is market value of Flipkart or Ola, and what is their net worth, right? Neither Flipkart makes profit nor Ola makes profit. Clear? But the value of Flipkart could be close to 60,000 crore, right? They act on the basis of replacement model. If I have to have the existing structure, this presence, this product, this network, this go down, right? And this manpower, how much I have to spend as of now? Clear? And that turns out to be close to some, I don't know what is the market value, but at point of time it was close to 50,000 crore or maybe 60,000 crore, and that value was much higher than the value of those organizations which have been in existence for years together. Clear? Be it a cement company, be it a FMCG, their value was much lesser than this only, right? Because replacement model act upon it. That is the power of valuation. Yeah. And that's the only reason in case of startup, the original promoter have 100% with them. By the time it stabilizes operation, his holding reduced to only 3%, 4%, 5% only. Look at Paytm. क्या हो गया? स्टार्टअप कौन कर गया? हाँ कर रहा ना. Yes, I'm happy he's doing something good. Keep it up. Don't give up. या छोड़ दिया?
नहीं नहीं
हाँ.
कंटिन्यू कर रहा है नहीं कर अच्छा
Remember, there are 10 critics around you. They will disgrace you. All right. But only one and one is going to increase you, and the one is you and none other than you. Right? We always believe somebody should come forward and clap for you. Right? But then you clap for yourself. At least you have thought to do something different from rest of the people around. Most of your classmates are still busy in finding out the shape of a burger and the pizza. They are spending a lot of time, money, and energy resources on deciding who is going to have the bigger share of the available pizza size. Clear? So, I'm indeed very happy those who have got something to do different from rest of the crowd. Don't be part of the crowd. Don't be part of the history. Create your own history. All right? And everything is possible provided you are distinct from the rest of the crowd. We are all different. We are not same. But out of that difference, we have to be distinct. And you know, this distinct is not by default. It's a distinction that you acquire by virtue of sheer hard work. All right? So it's good that you think, you act, and no matter if you fail, don't bother. We never fail in the life. My dear students, my dear children, remember, we never fail in the life. A project may not take off, but will give us a lot of experience. And the value of experience is much more than momentary success. So out of 10 startup, 9 fails every year. Idea is good, everything is good, but fails. See, understandably, they believe that there is 100% payout ratio. Clear? Less than 100 is not a crime. But set of assumption emphasizes only 100% dividend payout rate. All right? They may go 90%, doesn't make a crime. It's not a crime. What is important us to believe that they do not believe in retention of profit. So when you don't believe in retaining the profit, right? So your value of the firm will increase by giving maximum amount of dividend. Appreciate the logic. One set of logic says, look up, my dear children, I need more than 90 hours to teach this paper. और 90 hours में तो आपका पूरा सेमेस्टर खत्म हो जाता है, right? What value market assigned to your entity? What value market is going to assign to your entity? So what we talk about? Yes, there is set of assumption is this one only. We talk of value of the firm, and the entire theory of capital structure address only one issue. What happens to the value of the firm if we change leverage ratio? Clear? That is, if I change DE mix, if I change balance sheet ratio, if I change capital structure ratio, what is going to happen to the value of the firm is the essence of theory of capital structure. Right? So we have got two theories to discuss. One is net income approach. All right, clear? Now, I wish please get the book as early as possible. Otherwise, आप बाद में ढूंढते रहोगे. In exam, you have certain numericals. All right. The value of the firm as per NI approach. Let me explain the gist, the essence of this theory of NI. Rest you can do it. Assumptions and this, etc. As per NI approach, the value of the firm can be increased or decreased by increasing that component or reducing that component respectively in your capital structure. संसार संस्कार संस्कार जो भी हो राम प्याऊ सुन. In NI approach, our presumption is value of the firm depends on capital structure. Further simplify, value of the firm depends on combination of debt and equity. All right?
So V equals to E equals to.
अरे रुक तो सही मेरे काका. Second position, yes. तुम्हें समझ में आ रहा है बेटा? कोई दिक्कत तो नहीं आपको? All right, comfortable? Good. Yes. So value of the firm can be increased by increasing quantum of debt or debenture in capital structure, or we can say the value of the firm can be decreased by decreasing value of debenture in capital structure. Right? So what we argue? We argue capital structure is relevant. Capital structure is relevant in estimating the value of the firm. In estimating the value of the firm. All right? Clear? Yeah.
डेट तो फिर कॉस्ट ऑफ कैपिटल रिड्यूस
वो
कैसे
भी-
होता है कि डेट को हम लोग इंटरेस्ट पे कर रहे हैं तो फिर इंटरेस्ट जो निकल रहा है वो पैट से निकल रहा है या फिर एबिट से निकल रहा है तो फिर एबिट में अगर रिडक्शन हो जाता है तो फिर कॉस्ट ऑफ जो हम लोगों को डिविडेंड देना पड़ता है वो भी कम हो जाता है सो दैट इज हाउ कॉस्ट ऑफ कैपिटल रिड्यूसेस
नहीं
सर ये
बेटा
ये
यहाँ से यहाँ आने में मेरे को 40 साल लगे. होल्ड ऑन, लेट मी एक्सप्लेन. जब मैं समझा दूँ फिर मैं आपको समझाऊँ. ऑलराइट, कम ऑन.
सर वैल्यू पर ईबिट जिससे हम लोग बता रहे थे तो सर वो यही कहना चाह रहे थे कि ईबिट अगर हम लोग हाँ
आपकी किस अजम्पशन में लिखा है कि EBIT कैन बी चेंज? गो थ्रू ऑल द अजम्पशंस. व्हाट दे से, वी डू नॉट एक्सपेक्ट मेजर डिविएशन इन, there is constant level of income and that is not going to change overnight. If you read all assumptions, one of the assumption was, am I right? मेडसन साहब, एक assumption में लिखा है, अगर आपको याद हो, वो assumption ये थी आपकी, operating earning of the firm are not expected to grow or decline over a period of time. So when operating income is not going to change, then the logic given by you that EBIT will increase or decrease doesn't hold good.
सर EBIT से हम लोगों को पैट निकालने के लिए टैक्स एंड इंटरेस्ट हमें डिडक्ट करना पड़ेगा. अजम्पशन में ऑलरेडी टैक्स का एग्जेम्पशन दिया हुआ है बट इंटरेस्ट का नहीं दिया हुआ.
नहीं, पर हम ये मान के चलते हैं ना कि no major change is expected in level of EBIT. So what is going to be decisive things? The decisive thing is going to be the cost of capital. Decisive point is not the level of EBIT or PAT subject to interest or tax. No. The decisive point is only one. If I change KO or overall cost of capital, will it help me to increase or decrease value of the firm? ठीक पढ़ा है महाजन साहब? गर्दन पूरी ला देना सर, समझ में आया
सर आपने
I'll explain, don't worry.
स्टेटमेंट का फिर
अरे रुक तो सही काका, रुक तो सही यार. बेटा फाइनेंस है, एक बार पेपर देखना, मैं इस बार अच्छा पेपर सेट करता हूँ आपके लिए. कहाँ गया मस्त पेपर? लेट मी सेट द पेपर दैट इट हैज टू कम फॉर MBA लेवल. मजा आ जाएगा.
आपको
Yes. Neighbor's pride, owner's pride and neighbor's envy. Onida. Have you seen Onida commercial? अच्छा, आप उसके बाद क्या हो? Look at जरा वो YouTube चला के देखना. बस वो है ना, वो क्या कहते हैं, Honest pride, neighbors envy and honest pride. Right? So, understand what I'm going to say. What for this we are going to study? We are going to study capital structure theory only from the preposition of determining the value of the firm. Alright? As per these theories, we argue that capital structure has relevance in determining the value of the firm. Alright? And we also argue that in capital structure, we have only two sources, debt and equity. Preference shares and return earning, we are not looking at these options. Alright? Now, what it says, the theory simply says, value of the firm depends on overall cost of capital. Right? So, value of the firm can be changed by changing the component of debt in capital structure as per net income approach. Right? Now, set of assumptions that we have gone through argues, what they argue, that we don't expect major change in operating income or EBIT. Alright? That is what almost constant we presume them. Alright? So when they are not going to change drastically, then value of the firm, while EBIT level remaining same or no change, will depend on overall cost of capital. Right? So Shriran Raju logic says, if I take debenture and if I increase the quantum of debenture, what I'm going to do? I'm increasing cheaper cost of funds. What I'm going to do? I'm increasing lower cost of funds, because we presume debts is a cheaper than equity, right? Or a debenture is less costlier than equity. So in a given set of circumstances, if the component of lower cost of funds increases, what is going to result? The result is going to be the overall cost of capital is coming down. Clear? And to which we call KO. So if I divide EBIT by KO, outcome is value of the firm. What is V? V is to weigh. Yes, V is to weigh one, market value of debentures and market value of equity, S plus B. Or other way is, if I divide EBIT by KO, outcome is value of the firm. Alright? Now, you all are genius. Alright? Suppose this is the equation, value of the firm is equivalent to EBIT upon KO. Right? Now, if this denominator keeps on going down and down and down, this is going to increase. Even if it remains same. Shriran Raju, what am I going to do? This we believe is going to constant, and this component is going down and down and down and down. Therefore, this V will go up. Right. So what is the argument? Argument is simple. It simply says, if you increase quantum of debt in your capital structure as per NI approach, the value of firm will increase, but overall cost of capital will come down. Now, if you have the book with you, read few lines, few pages, and things will be crystal clear. At home, you will struggle. Sangram, घर पे जाओगे समझ भी नहीं आएगा. तो जो पढ़ाया है उसको भी रिवाइज कर लो. Read what is there in the text and go accordingly.